Hey Bowtie Nation, Joseph Hogue here with an informal video and your first step to always picking that perfect stock to buy. Now I showed you in our bottom-up stock picking process in the last video, the one used by analysts on Wall Street, but even they don't start with the 10,000 stocks traded on the US exchanges. Before you compare a single stock, you need to narrow down your list, and today I'm going to show you exactly how to do that. I'm going to walk you step by step into using any stock screener to get started investing. I'll use the screener on Yahoo Finance because it's free and available to everyone, but these filters can be found on any stock screener, so by the time we're done today, you're going to be able to use any platform to find your stocks. And we're going to start here on Yahoo Finance, and if you go over to the research in the menu bar here, you're going to see screeners. You're going to want to click on the screeners there. And now you can scroll through. They do have some of a pre-built screeners, some great screeners here to look through. I usually like starting with creating my own equity screener. What I'm going to do here though in this equity screener is talk you through some of the filters. So at least if you are using these pre-built screeners, you can understand how they're screening and how they're filtering for stocks. So the first thing you're going to want to do is click on this equities screener here. That's going to take you to the main page, and you can see without any filters here, there are more than 10,000 plus stocks. That is impossible for anyone, even the best bottom-up stock picker out there, folks. They do not start with all these stocks in the entire industry or in the universe. So you do need to start with a stock screener like this, filter down to, I'd say, between 20 and 30 stocks. You never want to use a screener to filter all the way down to 1 or 2 stocks to buy, okay? Because you still need to use those and that analysis that I showed you in these other videos, in that bottom-up stock picking analysis, in that top-down process that we showed you, and in our ratios video as well. You always want to use a screener to narrow down your list to a more manageable 15, 20, 30 stocks that you can then start researching to find that best stock to buy. Never trust a screener exclusively to pick your stocks to buy. Okay, so what we're going to do, we're going to start here with the equity screener, and we're going to click on equity filters. This opens up our box of different filters that we can use. I'm going to talk you through some of the ones that I use. And again, the important part here is that you understand what these filters mean so you can choose which ones you want to use for what stocks you're looking for. First, we're going to go here to the market data one, and we're going to go here to exchange. Now, this filters for the exchange on which the stock is listed. Okay, you're going to see here the NYSE, so the New York Stock Exchange, the NASDAQ. Those are the ones I primarily use because those are going to be US listed stocks. You might also use this OTC markets here. That's going to be your penny stocks. Okay, we're not going to click that one for today, but we're going to look for the NYSE, so the New York Stock Exchange, and the NASDAQ stocks. You'll also see the American Stock Exchange there, Amsterdam, ASX, Athens. So you've got a lot of different stock exchanges depending on where you're at. After that, a lot of times I'll go here to the index coverage universe. You've got things like the S&P 500, the Dow Jones, the NASDAQ, the Russell 2000 small caps. A lot of these are just narrowing your list down further to a certain size or a certain market of stocks. Okay, these are going to be covered by a lot of your index funds. With the S&P 500, these are the 500 largest companies in the United States. The NASDAQ 100, those are going to be more tech focused, and the Russell 2000, those are going to be small caps. You can still filter for some of those things. So you can filter by market cap and get those 500 largest stocks anyway. You don't have to use this S&P 500 filter. But if you want just those stocks in that index, then you would click on this. Another very important filter, 2 filters here, is the sector and going to be the industry. Okay, the sector, 11 basic sectors of the economy. Those companies within those sectors that serve a common purpose. So you're going to have things like consumer cyclical, financial services, basic materials, real estate. Okay, all the stocks in the real estate sector there. This is very important for that top-down process that we talked about, where if you're looking at the state of the economy, different economic scenarios, and which sectors are going to benefit, then you're going to want to start here with the sectors, and you're going to want to target those sectors that are going to do best in that economic environment in which you find yourself. With the industry, you have to select a sector first. So if we select basic materials there and then go to industry, that's going to give you the industries within that sector. So a way of just fine-tuning your selection a little bit more into the sector, okay? Because obviously within that basic materials sector, you've got a lot of different types of industries. The chemicals industry is going to perform much different from maybe the copper or gold industry, as well as the coal industry and the steel industry. So whenever you narrow it down by sectors, you also want to look into the industries, see what kind of industries are in there, and if you want to narrow it down further in those. We'll also look at the beta here. Now, beta is, like it says here, a measurement of how reactive a stock is compared to the overall market. Okay, a beta is a very good indication of how risky a stock is, how much it goes up and down. Okay, this measures how much a stock goes up and down compared to the market. Say if the market, which is usually the S&P 500 here, the S&P 500 went up, say 1% on a day, how much would that stock typically go up or down? Okay. High beta stocks, your tech stocks, your growth stocks, those high volatility but potentially high return stocks, they're going to have higher betas. Okay, they're going to have betas of 1.5, even 2 times the market. So which means if the market goes up 1%, that stock is going to go up to 2%. But it works the other way around too. If a stock has a beta of 2, tends to be very much more volatile than the market. If the stock market goes down 3%, that stock could fall 6% on the day. Okay, that is not a guarantee if that's going to happen with this beta measurement, but it is a good rule of thumb, okay, for a stock that if it tends to go up much more than the general market, it's going to go up much more, but it's also going to come down much more as well. So I don't usually use this a whole lot, but it is very important if you're looking for maybe some safer or low volatility stocks. Okay, there you would be looking for stocks with a beta of less than 1. Here, maybe 0.2 to 0.8. You toggle this, and that's going to find you safer stocks, generally safer stocks than the market. It's going to show you stocks that don't tend to lose as much when the market does fall. And last in here, we'll look at some of the short interest. If you look at the short interest percentage of float, this is just how many shares are shorted compared to how many shares are actively traded or available there are in the market. This is helpful if you're going to be looking for any short squeeze stocks, but you do need to look at that bear case, folks. Again, you do not want to use these stock screeners as your only option or your only analysis to pick a stock. You don't want to screen it all the way down to 1 or 2 stocks that you buy just from the stock screener. If you're going to be looking at short squeeze potential stocks or stocks with a high percentage of their floated shares shorted out, you want to do that extra analysis and understand the bear case for those stocks, because if a stock has 20 or 30% of its shares shorted by short sellers, there's usually a reason for that. Okay, the short sellers don't just pull the stock names out of their ass and say, "Hey, I want to try to push this stock lower." They have to usually have a reason, or they think they have a reason that stock price is going to go down. That's why they're shorting the stock. So it's always helpful if you do want to bet on these stocks with a high short percentage of float that you at least understand the bear case. That way you understand if it's wrong or if it's right. If it is right, if you do believe with the bear case scenario and that stock price is likely heading lower, you can either avoid it or you can join those shorts on the short side as well. Next here, we'll go over to the ratios. Just did a couple of ratios video, one with Brian Feroldi over there at Long-Term Mindset. We also did a ratios video here in the series of how to pick stocks. Great ideas there on how to pick stocks through those ratios. Make sure you catch that, folks. I'll link to that in the video description below. But these are just those fundamentals, those fundamental ratios and what they mean for the company. Again, it isn't just that the return on equity here is going to be above 20% or a certain number. It tells you a story of that company. Okay, these ratios tell you a story, not just that the return on equity is high, but why is it high? Why is that net income over the equity so much higher than some of these other stocks? Okay, why is the gross profit margin so much higher? Do they have some kind of a competitive advantage in pricing power over suppliers or over customers? You need to understand these things in the ratios, not just comparing the ratios, but understanding the story. So again, one of the ones I like to look at here is this return on equity, this ROE. See that other video on the ratios to understand what that is exactly. It's the net income divided by the average shareholder's equity. But with a lot of these, it's going to depend on what sector or industries that you're looking at. Okay, what is a good ROE or return on equity in one industry might not be one for another. So a lot of times you kind of want to filter this down by industry and then look at the ROE in each industry to get a good idea of which stocks are doing better in that industry. Okay, comparing the return on equity of maybe an Nvidia with a material stock isn't going to tell you really which one is better or worse, because I can almost guarantee you the return on that Nvidia stock is going to be better than the one in the material sector. It's just how those sectors are. But if you compare that material stock with another material stock, the ROE in that, it's going to give you a much better idea of which one is being managed better, which costs are being managed better to produce that higher return on equity. So very important. A lot of these ratios, you want to compare them sector to sector and stock to stock, okay? Another one I usually look at here is the debt to equity. We got a few of these. We got total debt to EBITDA. We got net debt to EBITDA. I usually stay with just the basic debt to equity ratio here. And this is going to be an important one when you're looking at value stocks. We'll actually go through an example of applying all this, finding a value stock that isn't a value trap later on. But you want to use this debt to equity. Again, if it's something like a consumer staples sector or some of these other sectors, you're probably going to have higher debt to equity just because they've got more stable cash flows. The utility sector usually has very high debt to equity. That doesn't mean it's a bad stock or a company in danger. It's just how that industry or how that sector tends to use more leverage because of stable cash flows, okay? Whereas the debt to equity for most tech stocks are much lower. So again, you want to compare these within the sector to really get an idea of where it is. But for most companies, I'd like to see a debt to equity of below 50%, okay? So not quite as much leverage as some of the other ones. We've also got here the current ratio. The current ratio is going to be the current assets divided by the current liabilities. And again, on the balance sheet, those current assets and current liabilities, current means it's within 1 year. Okay, so current assets, things like cash, things like inventories, things like receivables, things that are going to be able to convert to cash within 1 year. And the current liabilities, things that are going to be paid within 1 year. Okay, so this is very much a cash and current survivability of a company. Here also, you've got your margins. We went over that in our ratios video. Very important here. The gross profit margin. You've got the net income margin, which is the net profit margin, and then you've got the EBITDA margins down here as well. Find EBITDA margin right here, okay? So these are going to be your main margins for profitability, okay? So your main profitability margins, profitability metrics. You've got the net income margin here. That's going to be your net income divided by your total sales. Your gross profit margin is going to be your gross income divided by your total sales. And then your EBITDA margin, that's basically your operating margin, okay? Your operating income divided by total sales. And remember, what this tells you is how well the company is managing its costs at different stages in the income statement in its production. That gross profit margin is what is left over of total sales after paying production and after paying production and suppliers. Okay, so how much pricing power does it have against not just its suppliers but also against its customers? It can be a great clue into the brand value, the brand recognition, and the size of the company. Then you've got the EBITDA margin, or your operating margin. So how much of those total sales are left after, of course, the gross and cost of goods sold, as well as operating expenses. So your selling, your marketing, your general, your other expenses. Okay, how well is management managing those expenses? How efficient is management at turning revenue into that operating or that EBITDA margin? And then you got net income margin right there as well. Another one we don't talk quite as much about here on the channel, this Altman Z-score. This is a great measure of financial survivability. It's very important for value stocks. I generally like to do my own individual filters here. You can see here it does a lot of the filters within this Altman Z-score. Okay, it's a lot of this is the working capital over total assets. You've got retained earnings over total assets. So a lot of these you can kind of do your own filtering for if you want to break it down, maybe use some of these but not others. But the Altman Z-score is, again, just a measure of financial survivability for some of those deeply distressed companies. If you're looking for value stocks, it's going to be very important. I would say above 3 here for those value stocks. So we'll be looking at some other filters, maybe price filters, price to earnings, price to sales, to find those deep discount, cheap value stocks. But then you want to go here to a survivability one, clicking on here above 3. So you find not just those companies that are cheap, but those that actually have the financial survivability to get out of that cheap situation. Okay, folks, a lot of times those cheap stocks you find, the stocks that have gone down 30 or 40 or 50%, they're cheap for a reason. There are some serious problems a lot of times with debt and with the sales growth of that company. So you don't want to just look for cheap stocks on a price to earnings basis. You want to find those cheap stocks that also have the survivability to dig themselves out of their current problem. Also going to look here at the dividend yield. Okay, obviously very important for you dividend investors, income investors. You can go here 0 to 2%, 2 to 4%, above 4%. Now, personally, if you ask me, I don't think any stock that pays under 3% is truly a dividend stock. Okay, I know there's a lot of those tech stocks, Apple, Microsoft, that do pay dividends. They pay dividends under 1% or 2%. They've started returning some of that cash flow to investors, but it's still not really a dividend stock in my book. Okay, so if I'm looking for a dividend stock, I want something over 3%, maybe even over 4% for some of those really good payers. And for our final ratio here, we'll probably look at maybe the EBITDA over the interest expense. Okay, again, just like we talked about in our coverage or in our ratios video, as well as the one with Brian Feraldi there, look for that one. I'll leave a link in the description there for that. This EBITDA over interest expense. Okay, so EBITDA is generally your operating income. Okay, so the earnings before interest, taxes, depreciation, and amortization. Okay, that's going to be your main operating income there on the income statement over interest expense. Okay, obviously the interest expense, what the interest rate is on their debt and whether they're paying on that debt. Again, this is very good for financial survivability for those value stocks. You want to make sure that the company is creating enough EBITDA or enough operating income to at least cover its interest expense. Okay, any company that isn't even covering its interest expense with operating earnings, it's going to come to a point where it's not able to refinance that debt, and it's going to have a real time paying for that debt if they can't at least cover their interest expense. This is another one that's very popular with investors searching for those zombie companies. Okay, the zombie companies that can't even cover their interest expense. We've also got some performance measures. If you're looking for stocks, kind of a momentum idea with 52-week price highs, or maybe with a value stock, looking for those that are hitting their 52-week lows. I don't generally use this. I know, again, it is popular with momentum investors and value investors trying to find those stocks that are hitting their lows, or trying to find those stocks that continue to reach new highs. Find those if you're doing a momentum investor or the value investors there. Here we got the financials. With the three financial statements, you got your income statement, your balance sheet, and your cash flows. Obviously, as an analyst, I went blind making cash flow models, studying the cash flow statement. Income statement, I'm not quite as much a fan of, just because there are so many shenanigans, so many accounting tricks that companies can use to make that income statement look better. But it is something you want to look at. Things like your change in revenue, things like your change in net income and your margins there that we talked about. Here in the income statement first, you're going to want to look at a change in revenue or change in net income. Again, I don't look at net income nearly as much as I do that change in revenue, as well as the changes in the cash flow statement, just because there are ways to trick the income statement and make your net income grow faster than actually it's really going. Had a great conversation with Brian Feraldi there about that in that video, about how to test for earnings quality, how to compare the net income growth with the cash flow growth in a company to really make sure that it's not using too many shenanigans there in the income statement to make the income growth look better than it actually is. But here, always want to look at change in total revenue, see if the company is growing its revenue by at least the speed of the industry or the speed of its market. If it can grow faster than the market itself, then it must have some kind of competitive advantage that it's turning that into some kind of a faster market growth. I like to follow the trend here more than just the 1 year change. So usually I'll narrow my list down with maybe a filter for the 1 year change above 10%. And then when I do go deeper into those stocks and analyzing those stocks, I'll make sure it's more than just a 1 year change here. Here in the cash flow statement, we can see a change in cash flow from operations. So that core operational cash flow, again, that's a great metric to compare against that net income growth. Okay, what are they reporting for net income growth compared to what are they reporting for cash flow from operations? Okay, that true operational cash flow growth. If they're reporting net income that grew 20, 30, 40% over the past couple of years, but their change in actual cash from operations is so much lower, is 5% or flat, there are definitely some accounting shenanigans that going on at this. The companies cannot grow their net income much faster than their cash from operations forever. Okay, there is going to be a reckoning. The bill always comes due, folks. Next here, we can filter for valuation. Okay, how pricey is this stock? I'm going to go into more detail on this in our next video, a whole video just exploring these valuation topics like price to earnings, price to book, price to sales values. But again, you need to adjust these for growth. So you're not just trying to find cheap stocks here, folks. Again, you can find a stock trading for a price to earnings ratio of 5 times price to earnings, which seems extremely cheap. Very few stocks are going to trade for less than 5 times price to earnings. But is it cheap for a reason? Okay. Whereas you can also find stocks that are trading at 100, 200 times price to earnings. I know Palantir right now probably trading for 1,000 times price to earnings. Is it expensive? Is it cheap? You don't really quite know until one, you adjust it for its growth. So this price to earnings to growth ratio is helpful for that. That's gonna adjust that price to earnings ratio by the expected earnings growth over the next 5 years. It says here, you're gonna adjust for growth, or you're gonna dig deeper into that company to see why it is trading so cheaply. Okay. Why it's trading so cheaply, why it's trading so expensively. Okay. So if it's trading very expensively, you want to adjust it for growth and then compare companies across that to see, which ones are still cheap with that level of growth. If it's cheap or inexpensive, so a very low PE, very low price to sales ratio, you're going to want to find out why it's trading so cheap and if it's a discount or if it's a value trap. For some of these specifically, I used to use the enterprise value to EBITDA measure for when I was working in venture capital. Very popular investment banking and venture capital metric here. This enterprise value, that is the market cap, so the total value of all the shares there in the market, minus out any cash, but plus back any debt. Okay, it's a very good measure, a very good valuation measure for highly indebted companies, okay, or for adding back in that debt into the market valuation to get a little bit better idea than just using the market cap, which doesn't include that cash, doesn't include that debt on the balance sheet. That divided by the EBITDA, again, earnings before interest, taxes, and depreciation, that's going to be your main operating income. Okay, so what is the value of this stock in the market minus its cash plus back its debt? So a fully inclusive enterprise value divided by how much is it generating in operating earnings each year. We've also got here the price to sales. Okay, this is probably my preferred measure of valuation for most stocks here. It's my preferred over that more popular price to earnings ratio. Okay, you hear the price to earnings all the time out there in the markets. But again, there are just so many accounting shenanigans, accounting tricks that companies can use within their income statement to make that net income or those earnings look better. I like to start with the top line here, just price divided by the sales, the total revenue of the company, because there are ways to manipulate those sales and that revenue higher for a company, but it is much more difficult than by the time you get down to the earnings. There are so many accounting shenanigans built into that income statement that earnings are basically whatever the company wants them to be. Starting with this price to sales ratio, so that's going to be the price, the full market cap of the company divided by the sales or the revenue for that year. That's your price to sales ratio, a great valuation metric. I recommend using that one more than the price to earnings. You've also got the price to book. Okay, for a lot of these, you're going to find specific measures are best for different types of companies. Price to book, great for bank and financial stocks. Okay, just because they tend to hold their assets and their liabilities or their loans and their deposits on the balance sheet at value. So it's a price to book value is going to show you a better idea of a more realistic idea of what that company is actually worth. And then you got the price to earnings and price to earnings to growth. Again, for any fast growing tech stock, any stock with a very high price to earnings ratio, you probably want to look at this price to earnings to growth ratio as well. Okay, that's going to be your price. So the market cap of the company divided by the earnings or the net income the company has generated over the last year, and then divide by that earnings growth. Okay, so it's going to adjust by the growth rate in that earnings. Gives you a little bit better idea of whether the stock is inexpensive to its growth rate or if it's still just very expensive either way. Okay, a lot of these stocks in tech and growth, they may seem more expensive than maybe some of your other sectors, maybe the financials or energy or your material stocks. They might seem very much more expensive on just a price to earnings ratio, but when you adjust by growth, if these companies are growing their earnings by 20 or 30% a year, when you adjust that valuation, they are very much the better deal in those stocks. Here we can also look at ESG, that's environmental, social, and governance. I don't generally use this. I know it's important to a lot of people. If it is important to you, you can go through here, find out how a stock or how a company is stewards of that capital and stewards of the environment. Research is kind of split on this. Either way, if high ESG companies do outperform, really when they remove the really bad offenders. Okay, I know a lot of times they'll clump a lot of just the really bad offenders in here as far as ESG scores, and that brings down the returns on those companies. So of course the high ESG companies tend to outperform in that. But when you do remove the really bad offenders, the really bad companies on that environmental, social, or governance scorecard, which is just a handful of companies that have really broken the rules many, many times. When you remove those, there isn't much of a distinction really between the performance or the returns of these high ESG companies or not. But if it is important to you, you can check that out and filter for those. Next, you've got ownership percentages here. I don't use these very much unless you're looking for some of those, the short squeeze or the value stocks. Very important when you're looking for those. Things like the insider ownership here. Of course, normally insiders don't own more than 15% of a company. If insiders own more than 15% of the company, that is going to be a very big, very high vote of confidence for that company that is going to be very tightly held by those insiders. Those are the directors and executive management within that. For shares held by institutions, this is generally much higher, okay? Generally much higher, held by institutional ownerships like ETFs, like mutual funds. These don't trade very much. They trade more than the insiders, but they don't trade much. So it's generally this higher ownership going to be a vote of confidence and just a long-term holding for the stock. So if you are looking at short squeeze stocks, value stocks, if you can find a stock that with a high percentage of shorted or a value stock that you're looking at that looks attractive, if it's got a high percentage of ownership by the institutions, by the insiders, that really basically just takes those shares off the market. It's got a very much more limited share pool to be sold and to really drive that stock down. So you're going to have a very good, much better support for a stock if you're looking for a short squeeze, if you're looking for value stocks, much more support to the upside for a stock if it has this high percent share ownership by institutionals or insiders. And on these premium filters here, I've never really used these. I've never used these premium filters. I don't think you need them. These are just ways of not doing the analysis yourself. You can do any of these by yourself. You get a maybe look at Morningstar. If you're looking at the fair value ones, these are just basically pre-filtering a lot of the things that we already saw before. So it's not something you really need to do. Just learn what some of these filters are, how to use them, and you're going to have all you need to pick your stocks. I'm going to take you through an example next, screening for that value stock with that rebound potential, but without falling for the value trap that destroys your portfolio. But don't forget to check out the rest of the videos in this Better Investor series. I'm going to link to the complete series in the corner here. Folks, take control of your money, okay? Stop depending on or relying on YouTubers to pick your stocks for you and then wonder why that stock falls apart, okay? Watch these videos. You're always going to know that you're investing in the best stocks for your portfolio. So we're starting over here in the Yahoo Finance stock screener. Again, all of these filters you can find on pretty much any stock screener out there, any platform. So we're gonna be looking for a safety stock, but not a value disaster. Okay, so folks, so many times those cheap stocks or the stocks that look cheap are in those safety stock categories, but they tend to end up being a value trap. Okay, the stocks that are cheap for a reason, and a lot of those, I'd say the majority of stocks that are trading cheaply on that price to earnings, price to sales ratio, some of those other ratios, stocks that have fallen 20 or 30% over the last year, there's usually a reason for that. Okay, so you very much need to do your research, work through a filter like this before you're going to be investing in those cheap stocks to make sure you don't get caught in that value trap. Here, we're going to go into our equity filters. We're going to first go into the exchange. So we're only going to be looking at New York Stock Exchange or NASDAQ ones. I wouldn't be looking at, if you're looking at cheap stocks or value stocks, I wouldn't be looking in the OTC markets, okay, because a lot of those over-the-counter exchange or those penny stocks, those pink sheet stocks, so to speak, they do not have the same kind of regulatory oversight. Those companies don't have to present audited financial statements, so you're going to have less information and less reliable information to go on. So whenever there's any doubt about a company's survivability or whether it's a good stock to buy, stay away from the OTC market. Just the NYSE and the NASDAQ will do us just fine here. Next, we're going to go down here to valuation. Make sure we find some of those cheap stocks. First, we're going to look at the price to sales ratio, and we're going to say below 1. Anytime you can find a stock with a price that is below their current year's sales, that's a pretty good start here, folks. Now, obviously, this is going to filter out a lot of the growth and a lot of the tech stocks. Again, when you're filtering for stocks, when you're screening for stocks, you have to understand that this works on a sector by sector basis, okay? When we do this, when we're looking for these value stocks, if we want to look for value stocks within the tech or within the faster growing sectors, then we would want to go there to the sectors. We would want to go to market data, go to sectors, and click on this tech so we could find tech stocks with maybe a little bit faster growth, but still trading cheaply, okay? If you're just keeping that open to all 11 sectors, and then you're narrowing it down by price to sales, price to earnings, some of these valuation metrics, then you're going to screen out a lot of those faster growing ones, okay? With trying to find cheap stocks within the tech sector, you might have to go below 3 or, below from 1 to 3 on a price to sales. You might not find anything below 1 or, some of these other sectors. Below 1, you're probably only going to be having, companies in the consumer staples or the slower growth ones. But we're going to try below 1 there. Then we're going to go here to price to earnings because I know a lot of people still like to use price to earnings. Below 10 has always been kind of a Warren Buffett metric. Anytime you can find a stock with a price to earnings below 10, then it's a good start for a value stock. Again, it doesn't tell you that this stock is a good investment or a cheap stock. It just tells you that the price right now is trading at less than 10 times the earnings that company is generating every year. So we need to do a little bit more research later to make sure that that's not cheap for a reason, that investors aren't fleeing that stock because maybe the earnings are going down or maybe it has some debt problems. Next, for those safety stocks, we would go in here to the income statement and look for 1 year change in revenue. And what we're going to do here, we're going to do a custom. We're going to have at least 5% or more of revenue growth over the last year. Again, I like to look at the trend here, so I would probably go into these stocks individually after filtering, after narrowing them down in this stock screener, go into that income statement and make sure that it's at least 5% year over the last few years, not just 5% over the 1 year. Not just that it got lucky, but I like adding this change in revenue here for our value stocks because I do want to see that the company is actually growing its revenue, is actually growing its net income and its earnings, not just, that might be one of the reasons why it's so cheap. If that 1 year change in revenue is below 0, or if it's a negative, if it's actually losing the sales growth there on that measure. And you can see we've already filtered this down to 162 stocks from more than 10,000 stocks. We've already filtered it down to 162. Personally, though, that's still more than I want to research. So we're going to go back in here to the filters and we're going to go to our ratios, our trusty ratios, try to filter that down to less than 100, down to less than 50. We're going to go to the debt to equity first here. Again, very important for those value stocks, for the cheap stocks. You go in here, you make sure that they're not over their head in debt. They're not over leveraged, because debt is the first thing that's going to kill a company when it's when it gets too high. So we're going to do below 50 there, below 50% debt to equity. Then we're going to go here to the ROIC, the return on invested capital. Again, that's a little bit more difficult to calculate. Talked about that with Brian Feraldi there in that video. The ROIC, the NOPAT, the net earnings or net operating profit after taxes divided by the equity or the shareholders' equity. So a little bit harder to calculate, but you've got it here in Yahoo Finance. I'm going to say above 10%. That's a pretty solid ROIC, especially for value stocks. A lot of these value stocks, a lot of these cheap stocks that are going to be triggered on this equity screener, on this stock screener, they're going to have a ROIC below 10%, and that's why their stock is falling. Okay, that's why their stock is so cheap, because investors just aren't getting rewarded for investing in that company. But here we've got companies that have an ROIC or return on invested capital above 10%. We're going to filter for that. And last here, we're going to use this EBIT over interest expense ratio. So EBIT over interest expense. Now that is the earnings before interest and taxes. So not necessarily the operating income, it's the operating income added back to depreciation and amortization. Not going to go all accounting nerd on you there, folks, but that depreciation and amortization, that's a non-cash charge. So even though companies can take that out of their income statement to reduce their taxes, it's not actually something that they have to pay. They don't have to pay that depreciation expense, that depreciation charge. So we're going to add that back into our operating income to get this EBIT number divided by what they're paying on their interest on their debt. Again, very good for a cash survivability or for a survivability metric to make sure that companies can pay this. So we're going to say above 3, any company that is creating at least 3 times earnings before interest and taxes, 3 times the amount that they're paying in their interest expense. That's a not, I won't say a fairly safe company, but they've definitely got their interest expense paid for anyway. And here, if I just click apply on this last one, see how many we've got left, down to 14 stocks. Okay, so we were down from 10,000 plus stocks traded on the exchanges down to just 14 stocks. Here we can shift it over here and see what some of those are. We've got Media Alpha, Smith Douglas, Puma Biotech, some biotech stocks here. We've got Heritage Insurance. You're going to find a lot of insurance, a lot of materials stocks here, a lot of those in the financials, things like that, just because they tend to trade at lower valuations. They're a little bit lower growth rate too. So you've got a lot of financial services, industrials, you got energy, but a lot of financial services just because, those tend to grow at a slower rate. So investors aren't going to be paying much for them. Okay. They're going to be value stocks. Okay. You always want to just use these filters again to start your research. I would probably not filter where you get down to less than 14 or 15 stocks. Okay. You still want to be able to have a good list of stocks to begin your research further, to narrow it down to the 1 or 2 really best stocks in a group, but you never want to filter it all the way down to just 1 or 2. It doesn't give you a good spot to start researching and to really find the best stocks with that quality research. So I just wanted to show you kind of a quick step-by-step how to use a stock screener. Again, you can use these filters on any stock screener out there. It's a great first step to finding those best stocks to buy, folks, narrowing down your list before using some of the ratios that I showed you in our last video and some of the analysis process in those other videos. Very important, again, that you do your own research here. You dig further into these. This is your money. You take control of your money. You're going to be happy. You're going to be a better investor. Okay, so do just this little extra research and analysis. You will be a better investor and you will make more money. Check out the video on the right for the next in our series and learn in 20 minutes what it took me more than a decade to learn on Wall Street. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.